Today I'm going to talk to you about investing in purpose-built student property. Purpose-built student property is a growing sector, with 46 investments launched to retail investors in 2012 and a further 21 investments launched so far in 2013. We believe that over £400 million has been raised from retail investors into the sector since the start of 2012. The investments on offer appear extremely attractive on face value. The investor is offered the opportunity to purchase leasehold property at a very attractive price, and they receive guaranteed returns for up to 5 years. Although most of the time, these guaranteed returns are only for the initial 1 or 2 year period. It is important for investors and their advisors to ask as many questions as possible and to dig deeper and do their own due diligence before investing in these projects. Today, we're going to cover 5 key questions that we believe all investors and their advisors should be asking of any student property investment they come across. The first key question that investors should be asking is who is the management company and what is their track record? For student property investment, the management company is extremely important. Their role is securing tenants and ultimately securing the rental income to investors, and this is where the return on investment comes from. Smaller companies may find it hard to build a brand and secure tenants, and therefore may find it harder to drive rental income and return on investment for investors. Larger companies can gain larger exposure, have a wider marketing budget, and therefore drive higher occupancy and higher returns to their investors. As the management company is so important, it's important for the investor to be aware of the management company and look at management companies with the largest exposure and a really strong track record of securing tenants and having high occupancy in the property. Management companies with the greatest exposure, the best brand and the best track record are the companies that investors should be looking to manage their properties. The second question that investors should be asking is the management company or the property located close to a university, or is it affiliated to a university? This is extremely important. If the property is affiliated to a university, they can often drive extremely high occupancy rates, as most universities will look to provide all first year students with purpose-built accommodation. This is often known as halls of residence, and most universities in the UK look to offer this to first year students. The university that the accommodation is located near to or affiliated with is extremely important and one of the key drivers behind demand for accommodation. Firstly, with tuition fees now increasing to £9,000 per year for many universities throughout the UK, students are becoming increasingly picky with where they look at to study. Students are looking to the universities with the highest ranking or high job prospects and are moving away from universities lower down the ranking order or in cities that aren't particularly well known for their universities. Demand for the top ranked universities in the UK is predicted to rise in coming years as students move away from the lower ranked universities and look to those universities with higher job prospects in order to get better value for money for their tuition fees. This is already evident with some of the lower ranking universities in the UK seeing demand fall by between 10 and 20% over the last year alone. This is important for investors who should look to align themselves with universities with high rankings and ones that are expected to have high demand for student accommodation and high student numbers moving forward. The third question investors should be asking is what other purpose-built student properties are located nearby? Basically, what is the competition? When were these properties built? What facilities do they offer? And how much do they charge? Investors need to ensure that they aren't buying a student property in a location with excess supply. Although demand is particularly important, if there's excess supply in the market, then occupancy rates may be low and therefore return on investment and rental may be low. Liverpool is a prime example of this, with 21 new student property schemes launched in the city since the start of 2011. As long as there is excess demand for accommodation, then competition shouldn't be a problem. But it is those cities where demand is falling, student numbers are falling, where they should be very cautious of investing. Therefore, investors should be very wary of demand and other student properties in the local market when they invest. Occupancy is one of the main things that investors should be aware of, and if there is too much supply, then the property may not be occupied and therefore no rental income will be received. The fourth question that investors should be asking is, what costs are they liable for? This includes the initial costs when purchasing the property and also the ongoing costs. The initial costs could be very similar to purchasing a residential property. This could include stamp duty, although for most student property investments they are less than the £125,000 stamp duty threshold. The other costs could be legal fees, conveyancing fees, and also land registry fees. It is predicted that most of these fees should be between £750 and £1,500 for most student property investments. The ongoing fees can vary greatly, but for most investments they will include ground rent, service charges, management fees, and any essential maintenance that may be required on an annual basis. It's very hard to predict what these fees are, but for most, ground rental should be fixed and the other fees can be variable. Investors should ascertain and get proof in writing of who is responsible for the ongoing costs with the investment. If there's a management company in charge, do they pay the ground rent and service charges, or do these fall directly back on the investor? They should also check that if there is a management company, do they get paid with a fixed annual fee, or do they take a percentage of the income on an annual basis? They should also check and get in writing whether the management fee increases on an annual basis. Investors should also note that certain fees such as ground rent and service charges may even be liable even if there isn't a tenant in the property and there isn't rental income received. Therefore, investors may have to pay these out of their own pocket. The fifth and final question that investors should be asking is there an exit strategy in place? This is something investors should be thinking of from the outset when they invest into the property or when they buy the property, as they need to know that there's a resale market should they wish to exit. With the majority of investments, there isn't any type of built-in exit strategy. It's up to the investor to sell the property on the open market. At present, the open market and the resale market for student property is not particularly well developed. In the future, it's likely that this could develop in the same way as residential and commercial property market has developed, where investors can sell the property to anyone they wish on the open market. One thing that investors can look for is developers that have a close affiliation or are linked to the management company. This shows that the interests of the developer, the management company, and the investor are closely aligned, as the developer may receive some sort of income from the management company moving forward. Although it should be noted that here the investor takes most of the risk. The main exit strategy for investors is likely to be to sell the property on the open market in the same way as commercial and residential property is sold. At this point, the resale market for purpose-built student property is not particularly well developed, but it is likely that moving forward this should develop much further. The main reason this market is not yet developed is that most of the properties on the market are brand new purpose-built properties, and therefore they're sold straight from the developer to the retail investor. When these properties then come back to market as second-hand properties in the future, that should then help to develop the resale market and the exit strategy for investors. A developed resale market is extremely important for the industry and extremely important for investors as an exit strategy. This will rely on continued, strong, attractive returns and high capital values. If the market becomes flooded with properties and rental values fall, this could leave investors with assets that are very hard to value and very hard to sell. Student property is an illiquid asset class, and it could take a long time for the investor to sell the property even once the resale market becomes well established. Investors should be aware of this from the outset and therefore not look to invest should they need the money short term or should they think that they may need to exit at a time very short term in the future. Investors should also be aware that it's extremely unlikely that banks will be willing to lend against purpose-built student property, and this could limit the potential resale market to cash investors only. It is therefore important for investors to consider their exit strategy from the outset. Will the returns on the investment be attractive in 2, 5 or 10 years' time? Will there be a readily available exit strategy or secondary market? And could the local market be swamped with properties when I come to sell in the future? These are all factors that could have a massive impact on selling the investment in the future. Apart from purpose-built student property, there are other options for investors to gain exposure to the market. The main options are collective investment schemes and also debt instruments such as corporate bonds. Both of these allow the investor to have exposure to the market, but it should be noted that these are likely to be unregulated investments and therefore unsuitable for the majority of retail clients. These type of investments should be considered illiquid and high risk, but for the right type of investor, they could be part of a well-diversified portfolio. The illiquidity comes with the fact that the fund will hold an underlying physical asset that can't be bought and sold quickly in the same way as, say, shares in a company can. This illiquidity is clear to see with the recent Brando Student Accommodation Fund, which has closed to redemptions and to new investors, and has cited this as due to a lack of liquidity and a large number of redemption requests. In conclusion, purpose-built student property is a very attractive asset class and something that for the right client can offer a number of advantages. Investors and their advisors should though be aware of the risks involved and should ask as many questions as possible and do their own due diligence before investing into any student properties. We have only covered a small number of questions in this video, but for more information, please download a copy of the Intelligent Partnership Purpose-Built Student Property Report. Thank you for listening.